Welcome back, everyone. Today's video is just a few thoughts and a bit of a comparison, not a thorough look through, but a bit of a comparison between some of the uranium ETFs that are around or will be around soon and a fund also that I've been asked about. Now, I have done bits and pieces of this in isolated videos, but this is the first one where I'm kind of comparing them once and for all. So what's a better place to start than my personal pet peeve? The URA ETF. Now, this one's been around for a while, so people love using this to point to the long-term chart of uranium equities. Now, my question to those people is, what about the other 55% of this ETF? People, have bought the Global X Uranium ETF because they I would think, want a diversified uranium portfolio. Unfortunately, Global X changed the composition of the ETF to one that's a bit more well-rounded and not, well, not what it used to be, and not what some people hope it is. That being said, if there are people out there who are looking for a uranium ETF that is about 45% uranium and 55% not really uranium, this is probably your ETF. So while this is a fairly diversified ETF holding 29 names, at least at the time of me making this slide, close to 55% of that, and this is me being kind of generous to the uranium part, 55% of that is not uranium. Some of the companies have light exposure to uranium or have heard the word, so to speak, but most of them, uranium is not the principal part of their value. And that's just me looking at the names. You should look at the names if you think I'm wrong and have a look and make a decision. Tell me where I'm wrong. Now, the other 45% is uranium. Although of that, again, at the time of making this slide, it shifts from day to day, almost 20% of the total was Cameco. So almost half of the uranium is Cameco. Could be fine for most people. And then another 9.3% of the total is entities, so Yellow Cake and Uranium Participation Corp. So you have almost 70, let's call it about 70, 75% of the uranium in the portfolio is based on Cameco and physical. And much of the rest, the remaining uranium, is just based on some of the bigger uranium names, bigger juniors, I should say, or bigger non-Cameco producers, but have rather small percentages of each. Now, if that is the exact type of thing that you're looking for, you're welcome. Here it is. You found it. Um, and if we're looking at the expense ratio, I mean, it's well above what you'd find on the S&P, but for a specialist fund, it's kind of in line. The liquidity is good, so if you need to buy and sell this anytime, any day, you'll get a good spread. You'll get it close to the market price, so that's pretty good. And I mean, the main downside is, yes, it's about 45% uranium. Next, we have the HURA.TO ETF, the Horizon Global Uranium Index ETF. Now, this one trades in Canada, so some people might have either indirect or more feed access, so that could be a downside for some people. But to others, or to, well, the average person who's looking at this ETF as an option, let's just go into what it has. It's a bit different from the URA in that this one has what I like to refer to as a 5 times 20 rule. Now, what is it? What do I mean by that? Well, if you break it down into 5 sets of 20%, you have approximately 20% Cameco, 20% Kazatomprom, 20% physical, 20% of the thing is the Athabasca Basin Big Three, and then 20% is, I'll call it everything else. even though it's not everything else. There are a number of uh, uranium companies, smaller uranium companies, I guess we'll go with, that are not included in the ETF. So, but that's just a breakdown of what it looks like. So overall, as an ETF type product, well, it is an ETF, but for that type of expected breakdown, I guess I would say, it's pretty decent. Personally, most of my focus and most of my money has been going into that last 20% of the everything else. But for an ETF, for a diversified ETF, it's pretty good. It's a solid option. Now, I like the composition and think that I would say that this is probably slightly lower risk than the URMN, which I'll get to in a sec, ETF, which is on its way. Um, Slightly lower risk, slightly lower reward. And I say that because this one has some more focus on the bigger, I'll use air quotes here when I say higher quality names, because I mean, technically they are, but there's some quality, really small names that are just unheard of. So technically, in theory, it should be lower risk with the big ones, but with lower risk, probably also lower reward because you have less of the super speculative things, which is completely fine for some people and completely reasonable. So on this one, the MER is slightly higher. So the basically carrying fees, if you will, is 0.75% plus applicable tax, it says, versus 0.69 for the other one. It's pretty close. Many ETFs in Canada have higher fees, but for this, it's rather in line with the other one. It's a bit higher. Now, the main flaw that I would see in this one is liquidity, in that you can't necessarily, at this point, and this may change as more people get in the ETF, you can't buy or sell the ETF at any point with a 1 penny spread. I've checked for a few days, and every time I look, there's like a six penny spread within the bid and ask. Sometimes it closes when there's someone actually buying, but the spread is slightly higher, and that is the main downside at this point in the ETF. If they could close that up, it would be great, but for now, that's it. Next, we have the North Shore Global Uranium Mining Index, URMN for abbreviated. That's probably going to be the ticker. This one's not available yet. It was supposed to be available in November, but now it looks like December, and we can thank the SEC for doing such a thorough job on that. Now this one, it's more diversified. I guess you could call it 15, 17, and never mind. It's diversified. Allocations are set up in a way that are capped based on certain sizes of market cap. It seemed to be more particularly thought out in terms of allocations and less market cap with minor caps related. So more into the breakdown of this, and I'll clarify because it's, a bit more broken down than the other ones. You have 15% Cameco, 15% Kazatomprom. So that's 30% in what I'll call the majors. Then you have 17.5% in physical. And the interesting thing about this is they seem to have not mandated, but implemented a cap so that if more publicly traded physical uranium things pop up, then it won't ever kind of dominate the composition of the ETF, which I think is really interesting. Then you go down to the big names. And when I say big names, I mean big names sub majors. So you have the smaller US producers and some of the big Athabasca plays, and they're at 4.9% each, which is interesting. I mean, it seems to be considered, which if you like that or not, that's up to you. And the rest, The rest of the non-big names, so the smaller ones, have between a 1.2 and a 0.8% allocation each. Now, this means that you have more of the big name juniors and the small ones, which does kind of increase your risk, although it is more diversified, so that's anti-risk, I guess you can call it. And so it does give you more upside potential having more of the ones that can go up more. And the one thing I'll say about this one, or the URMN, along with the HURA, is that a number of the smaller uranium equities, the like 1% ones in this and the smaller ones in the HURA, is they have fallen below the minimum holding threshold for the ETF. So it is possible that they may be kicked out of the ETF, and that can cause some selling in those names. But when they reach the market cap, they could be put back in. Now, I don't know if that's how the ETFs will handle it or not, but just based on me saying what the allocations are now, some may change obviously at any point because of market caps and prospectus rules and such. Now, because this is not available yet, we can't know things like how the liquidity will be. We can hope that it's good, but we'll have to take a look at that before we can make judgments on it. Now, as I kind of went off on a tangent on before, these holdings in the ETF always change based on market cap rules as they change, companies, time, anything can change. So I always do recommend always looking at the holdings of an ETF before you buy it, and also, if you can, read the prospectus to see the rules and how the ETF operates. I know this does take a bit of extra time, but it avoids accidentally doing something that we don't mean to do. Next, we have the Geiger Counter Fund, which is, I'll call it professional alpha, in that you pay a bit more in fees, but you have active managers that are trying to beat the market, beat the ETF, if you will. So, will they? I don't know, but that is the theory behind the Geiger Counter Fund. So on this one, the holdings change, and I have not been following it super closely. I do check occasionally, and from what I can remember, there are some decent changes, but it generally holds highly concentrated positions, well, not too highly concentrated, but professionally highly concentrated positions in the bigger little ones. And by this, I mean the big Athabasca plays or the US producers. And so they have high percentages in the ones of those that they like. And so as for another thing to check on this one is this one varies between trading at a premium and a discount to their net asset value. So as a value investor, one would look and say, well, maybe if I can catch it one of the times where it's trading at a 10% discount to net asset values, then it could be an even better idea. Or if it's trading above the net asset value, then it could be a less good idea. So again, it's another option, and it could be, it's a more tactical way of approaching the sector. Now, that being said, will it necessarily beat the market? No, nothing's necessary. Will it necessarily lose? No. So you're really betting on the people rather than the sector in general. Now, because I covered this in the other ones, I'll look at the specs, so to speak. The management fee is 1.38% as of the most recent fact sheet, and that is pretty fair for like an actively managed fee. Often you can have much higher, and the liquidity in it again is a potential downside in that it doesn't have that great liquidity. Now, this does allow it, or is part of the reason why it sometimes could be trading at a discount and sometimes at a premium. So take the disadvantage with a grain of salt because it could easily be your value advantage. So that's it for today. I know I didn't get too deep into breaking down too much on these things, but in the end, this is a personal preference type thing. So if you liked the idea of one versus another, that's really up to you. So with that, I will close down this video and say good luck, and hopefully you found some information that helps you make a decision that you are good with.